Welcome back to Self-Invested. My name's Lemuel, and in this video, we welcome back Ken Brooke, a qualified mortgage advisor, to talk about the current mortgage market. Now, if you're new to this channel, Ken was the mortgage broker that I actually used when I was buying my flat, and I actually had him on the channel around sort of 2 years ago, almost 2 years ago now, to talk about the Help to Buy and shared ownership scheme. But in today's video, we're going to be talking about the Bank of England base rate and how this relates to the mortgage interest rates, what's currently happening in the mortgage market, and have a look at some examples of actual mortgage rates that are currently available. And we're also going to talk about whether people should consider getting a 5-year fixed rate mortgage instead of the typical 2-year fixed rate mortgage, and if it's better to go for a fixed rate or a variable rate in the current market. And at the end, I'm hoping that we can also talk about Boris's recent announcement to allow people to put their housing benefits towards buying a home. Now, the timestamps for the different discussion topics in this video can be found down in the description of this video. So if you watch the video and you want to ever go back to a specific point in the video, you can just have a look down in the description, and I've timestamped all the different areas. As always, if you find this video useful, be sure to give it a like, because it will help the video to be seen by more people that can find it useful. But without further ado, I'm going to bring in Ken to talk about mortgages. How you doing, Ken?
Yeah, fine, thank you, Lemuel. Not bad at all, thank you. Very interesting times to be talking to you about mortgages and generally the housing market. So it's always a pleasure. And I can't believe it's 2 years ago since we did this. It seems only like yesterday. So
no, yeah. I was looking back at the video and I couldn't believe it was 2 years as well. Time's flown by. But yeah, blame lockdown.
Yeah, we can always do. Lockdown is a lot to answer for, but yeah, no, and it's nice now. I think that we've got a little bit of realism back into the world, but still a lot of our business is still done via this particular medium of Zoom, and it seems to work. So we're not going to knock it, and we use it as much as we can.
Definitely. Before we get started, I just want to congratulate you for your 40th wedding anniversary, which you celebrated on Sunday.
I did.
And we're recording this on Tuesday, by the way. But yeah, no, congratulations.
Thank you very much. Yeah, no, it was a lovely day back in 1982, and when perhaps some of the people watching this may not have even been born, dare I say. But we've done 40 years, and we had a lovely family occasion on Sunday with my 3 grown-up children, my 2 grandchildren, my 2 grandsons, my sisters, my sister-in-law, and yeah, we even had a singer come along for an hour, which was great fun. Wow. So yeah, good times had by all. Thank you.
Yeah, that sounds really, really special. That sounds really
very
wonderful.
Special. Yeah, it was a lovely day, really lovely day.
Yeah. But yeah, so talking about 40-year marriages, I think with the current state of the mortgage market and the way interest rates are rising, I think we're going to need 40-year mortgages for people to be able to afford these mortgage rates. And a lot of that is down to the Bank of England base rate, right?
I get your link. Very well done, sir. No, you're not wrong.
Yeah, that was a pre-prepared one.
Pretty good. No, I mean just to take that point really. We're experiencing the first sort of real increase in rates for, well, probably a good 13, 14 years, maybe even longer. I think the last time the base rate was where it is now, which is at 1%, was just before 2009 or thereabouts. So it has been a long time since we've worked in an environment where rates are rising. And you are right. If interest rates do go up, then pound for pound, if you've got the same term of mortgage, then obviously your payments will be higher than they would have been 6 months ago. But what is happening is that clients are taking longer term mortgages. So the net effect of that is that the monthly payments are then similar to what they were with the previous lower rates. But of course, they're taking the mortgage for a longer period, which means in real terms, it's costing them more money by paying the interest back over a longer period. So the ideal, I haven't yet done a 40-year mortgage. I must stress that we limit it to 35, but I'm not going to say it won't happen anytime soon, because it is one of the ways where you can keep the monthly payments down to a more manageable level in what is currently still a rising interest rate market.
We could take a few steps back. I I thought it might be helpful if we quickly just touch on the base rate, what it is, and how it relates to mortgage interest rates.
Yeah, of course. I mean, the base rate is obviously set independently by the Bank of England. The MPC, the actual committee, meet every month to discuss what they're going to do with the base rate, and the rates really started rising from a low of 0.1 up to the current level of 1% in a relatively short space of time. Historically, interest rates have been used to help stem inflation, because the theory is that if you increase savings rates, which is what the Bank of England base rate does, alongside making it more expensive to borrow money, people will save more, spend less. And in the old days, that would have been enough to perhaps bring inflation down, which the old definition of too much money chasing too few goods. But of course, when you bring in the necessities of what's pushing inflation up, which is the heating costs, energy costs generally, petrol costs, all those areas that most of us have to pay for, it's not something that's directly going to have much of an effect on inflation at the moment. But the government, the Bank of England felt that borrowing had been too cheap for a period of time, and have decided to go ahead with pushing the rate upwards, which of course then has a knock-on effect on interest rates generally, because the market rates will tend to go up similar or in line with the increase in base rate, which means it's more expensive to borrow any type of money, not just your mortgage rate. If you are running a credit card and it's on a variable rate, you will find that your credit card variable rate will increase as well, because that tends to be also linked into the Bank of England base rate.
Just on that, we're recording this on Tuesday, and I think the next announcement that the Bank of England are going to make on the base rate is going to be on Thursday, the same day that I'm hoping to actually release this video.
Sure.
And I think it's widely expected that the interest rate is going to go up again from its current high of 1% to potentially 1.25% or 1.5%. What impact is this going to have on the market?
Yeah, realistically, the rates have probably already gone up slightly. I mean, we are at the moment, just to give you a little bit of an idea, we had some rates change last week where, as an advisor, you're given probably 3 hours to complete an application with a lender. And if it's not done within that 3 hours, then the rate will disappear the following day. So I've had a couple of quite late nights in more recent times. I did a couple recently, one with Nationwide, one with TSB, one with Birmingham BM Solutions, just to get the rate for the client. So it's quite a difficult time for both clients and advisors at the moment, because you don't know how long those rates are going to be available for, and you can literally wake up the next day and find that they're gone. So it is a tough time, and the actual effect at the moment, it's probably slowing the market down. It's bizarre really, because there'll come a point where you'll look back and you'll see the point at which the market started to slow down. But because you're living it every single day, you can only go with what you actually see for yourself. And I would say that inquiries for new purchases have probably reduced a little bit over the last kind of month or so, and that's quite interesting. And we'll talk about the housing market generally in a minute. But I think that if you think logically, if you're about to venture into buying a property, you've got to deal with rising interest rates, potential increase in your monthly payments, increase in electric, gas, petrol, cost of living generally. So what tends to happen is people will take a little bit of a rain check, and they'll maybe just think, well, hang on a minute, can we really afford it? Do we need to wait just a little bit longer? And how is it going to affect us kind of moving forward? So the whole basis of the mentality of the market is really comes from when the Bank of England choose to make that decision to increase the rate. It's quite a big thing in the world in which we operate.
We're talking about rising rates. What I want us to do is have a look at some rates that you sort of prepared for us, just looking at different loan to value rates. What I'm going to do is share my screen so you can just talk us through the different rates. And what would be useful as well is if you can sort of give us an idea of maybe what these rates would have been, let's say, a year ago.
So prior to around about October time last year, so only 8 months ago now, you could get 2-year fixed rates at 0.89% and 5-year rates at 1.05%.
And this is for what loan to value mortgage?
This would have probably been round about the kind of 75% mark that we can look at there, and you can see how the rates have risen a little bit. It's. I'll try to explain the anomaly of the 5-year fixed rate, where it looks like you're paying a little bit more than the 2-year. It does depend. There are some, historically, 2-year fixed rates always used to be cheaper than 5-year fixed rates, but in more recent times, the 2-year money has become more expensive in what's called the swap markets for the lenders to actually get hold of. So you'll see there at 95% that you'll pay more for a 2-year fixed rate than you will for a 5-year fixed rate. Now, the slight gamble there is that we would have ordinarily said for a 95% mortgage, take a 2-year fixed rate, because you might create equity over the 2 years, so that when your mortgage comes up for renewal in 2 years' time, if your property had gone up in value and you'd paid some of your mortgage off, your loan to value, for example, might be 90% or less. So providing rates didn't change, you would have had a cheaper rate to look at in 2 years' time. The problem you now have when you're advising clients is that you can't make that statement with any kind of certainty, because if rates are rising, they could be significantly higher than what we're looking at the moment. So the default position at the moment tends to be we go for a 5-year fixed rate. Now, that's fraught with a number of issues. One is that if you are buying, for example, for the first time, and there are 2 of you, and it's the first time perhaps that you've lived together, and you suddenly decide after 1.5 years you don't get on anymore. The problem then is, if you have to sell the property, there is going to be an early repayment charge attached to that 5-year mortgage, which is going to cost you obviously quite a bit of money to get out of. Now, I can come at this from the fact that, as you said right at the beginning, I've been married 40 years now. So from my point of view, it was never an issue. But I've got clients at the moment. I've got 2 sets of clients who bought a property recently as first-time buyers within the last 12 months, who sadly have not gone their separate ways. They only had 2-year mortgages, fixed rate mortgages back then. So if they do want to sell the property, which looks likely, they've agreed to sell it at the end of the fixed rate period, when there won't be an early repayment charge attached. So in terms of giving the advice, you can see from there that these are very high rates compared to where they were 8 months ago. Are we going to see similar increase over the next 8 months? I certainly wouldn't want to take a punt on that, really, because I do think it's a really tough one to call. But you can see that if you want to eliminate the risk for a reasonable period of time, providing it works out on your affordability, then you would certainly be looking to take a 5-year fixed rate for sure.
With mortgage rates going up, so becoming more expensive, and people having less money available because gas and electric bills are going up, food prices are going up, are you seeing mortgage approval rates go down?
Good question. We are told that the affordability calculators that lenders use to assess how much they're going to lend to clients has been, in their words, tweaked to take into effect the increased costs. Only one lender at the moment I'm aware of is having a hang up about what the council tax is going to be on a new purchase, and that's Barclays. So if we go to Barclays for a mortgage, they want the exact council tax figure factored into their affordability calculator. So to answer your question, it's a funny one, because and again, the reason I mentioned Nationwide is that Nationwide have this helping hand first-time buyer mortgage, and it's genuinely for first-time buyers. If you have a sole applicant on 37,000, or you have joint applicants totaling 55,000, then Nationwide will lend you potentially 5.5 times your joint income. And that's quite a significant amount of money. And that, in fairness, is also up to 95% as well. So and that's another way that, in some ways, it's keeping the prices of properties at a higher level than perhaps it would have been if you start reducing the amount that people can borrow, because if you can't borrow the same amount of money, then it will force prices to fall over a period of time. Whereas at the moment, with the lack of quality property coming onto the market, there is definitely a huge gap in supply, and there's still quite a heavy demand for the right property at the right price. So anybody selling at the moment will get sometimes not just the price that they wanted, but what estate agents call offers in excess of, where you have to put in, if anybody does Sudoku, it's not Sudoku, sorry, anyone does Wordle, I think it's OEIO, but use audio as your first word if you do Wordle. I'm 78 unbeaten. That just keeps my brain ticking over. But OEIO, if you see OEIO on a property, it's offers in excess of. So it would be OIEO, offers in excess of. And so you have to put in what you think the property is worth. Now, what we are seeing to balance it off a little bit is that some lenders are beginning to downvalue property prices now, bearing in mind, what's happening generally with the market. So there is some adjustment taking place. But at the moment, if you're selling, great. But if you're looking to buy, often you're queuing up with 9-10 other people to see the property, and you possibly only got a 1 in 10 chance of actually getting it if you pay the sort of over the odds on the asking price.
The next thing, you sort of touched on this, and I think it's something that mortgage advisors can sort of advise homeowners on. But with rising costs across the board for mortgage products, with people that are coming to the end of their fixed rate period, they're gonna have to remortgage at probably much higher rates than what they were on previously. What options are there for people who are going to be going on to higher interest rates to reduce their monthly expenses from a mortgage point of view?
Okay, it's two things. If pound for pound, if you have any savings that you could put towards reducing the mortgage balance, then purely from the mathematical point of view, that would be an option to look at. Most people probably don't have a lot. So we touched on it right at the beginning. The only way realistically to reduce your mortgage cost if the rate is higher is to extend the term of the mortgage. That depends on what stage you're at in your mortgage lifespan, depends on how badly you want to keep a mortgage going to late 60s, maybe even 70. But that's something that will come about with talking to an advisor, because you might be able to reduce your costs in other areas potentially, so that if the mortgage has gone up, say £100, you can still afford it. The one thing I would say to everybody listening to this is, the one thing not to do is to stop paying any insurances that you have. So, for example, if you've got life insurance, critical illness insurance, income protection insurance, please don't stop paying those premiums, because I guarantee you, the moment you stop paying those premiums, something will come along that means you'll need to meet a claim on it. That part of your mortgage it's always separated, but I kind of lump the two together and say you've got mortgage and protection lumped in as one lump sum. Now, those protection policies are not going to change in price unless you've taken out something called a reviewable premium. We only advise on guaranteed premiums. So if I arrange some life cover for you, it will be guaranteed never to go up, and would obviously pay out, God forbid, if you were to die. But sometimes people say, I'm paying £60-70 in my insurances, I'll stop paying those and then I can afford the extra mortgage. Not good advice. If you make sure that you don't do that, particularly if you've subsequently had children and they're relying on you as the main income earner and all these other bits and pieces. We shouldn't forget about how important it is to protect ourselves against those situations that we don't really want to think about, that always happens to the bloke next door, but does occasionally end up on your own doorstep, and you at least you've got something there to help you through those times, if you've invested in those policies right at the beginning or any time, during your mortgage.
Would you say the same goes for pension contributions as well? Because I guess
Absolutely.
that's another thing where you don't see the benefits of it, right now, but it could be very costly in the long term if you don't continue to contribute now.
Yeah, I couldn't agree more. I mean, the main problem with pensions in the UK is that people, it's only a very small percentage of people that plan properly to be able to retire at a reasonable age. I mean, everybody's working longer these days anyway, mainly by choice. But yeah, it's your pension is your way of remaining away from, I call it the public sector, but not relying on the government to supply you with enough income to be able to live your lifestyle when you stop working. If you work all your life to be independent financially from, not always, but you're not having to rely on other people to make a contribution to your overall kind of income levels, then pensions are just as important. But again, I guarantee you, it's one of the first things that people look at if they're paying £100 a month into their pension and their mortgage has gone up £100. It's in their eyes, it's a no-brainer because they want to keep the house now, but in 20 years' time, when they're mid to late 60s and they've paid their mortgage off, great, they've got a house, but they've got no way of affording what will then be, I'm sure, extremely high fuel bills and everything else that goes with it. And I do think it's a very, very good point that you make and something that people should be aware of.
The last topic that I want us to discuss is Boris Johnson's announcement on benefits to bricks, where he plans to sort of change policies to allow people to put their housing benefits towards buying a house. I just wanted to get your thoughts on this as
I'm going to play devil's advocate
advisor
on this one first, and I'm going to ask.
Yeah.
I'm going to ask you why you think that announcement was made, and then I'll give you my honest opinion. But why do you think it's been done?
Yeah, I mean, the same as the reason why he announced extending the right to buy sort of benefit to housing association tenants. I think it's to sort of win voters to get support. He seems to be on sort of weak ground at the moment. I mean, he won the vote of confidence, but it was a worse result than anyone was expecting.
Yeah, I think you've hit it on the head. I mean, there's no substance yet to what the actual policy is going to look like. Mm-hmm. Back in the early 80s, which was, I'm sure, quite a long time before some of your subscribers were born. I was around then. Obviously, Mrs. Thatcher decided to offer the right to buy to council tenants, and council tenants were offered their property at a much reduced figure below the market value. So rather than pay rent, you pay towards a much lower mortgage, and then eventually, after I think it was 5 years, you could then sell that property on the open market. And a lot of people made a lot of money towards the end of the 80s and early 90s, where particularly if you look at the development of Docklands in the east of London, but back then people made a fortune because all of a sudden a big, the city offices were moving out to what were before then fairly deprived areas, and those people that have been clever enough to buy their property from the council made an absolute fortune, and good luck to them. I think the idea is based a little bit around that. I mean, they've thrown in the benefits side of it, which confuses me a little bit, because the reality is that most people can afford. I mean, are still going to have to pass affordability checks with a lender in order to be able to get a mortgage. Now, some benefits, if they're almost guaranteed, will be taken into account by lenders for a mortgage now anyway. So that's why I say we kind of want to see the belt and braces of it in terms of how it's going to work. So, for example, anybody at the moment that is claiming personal independence, Plan PIP, the old ESA, the employment allowance, all of those things can be taken into account for a mortgage now. I think it's just a case of maybe going back to 40 years ago, where there'll be more opportunities for housing association tenants / council tenants to be offered the opportunity to buy their property. But it goes again what we said right at the beginning about future resale. If you're the one person in the block of 20 that buys your property, it might be quite difficult to sell it when it comes along, because it will then be thought of as all your other 19 neighbours will be housing association tenants. And whether, not that there's anything wrong with that, but it will stop some people from buying into that particular block or that particular area. So there's a lot of discussion. I'm not against it. It proved very successful in the 80s and gave people an opportunity. Coming from a background where my parents rented the same property from the day they got married to the day they passed away in the open market, the difference then was they were what was called a protected tenant under the old Tenancy Act, where the landlord could only put the rent up by a small percentage each year. And so when my mum passed in 2006, she was paying £275 a month for her rented flat. Wow. And the open market value was about 850. So the only people, in fairness to the landlord or the landlords, the three brothers that I knew, they were great. All of their properties were on that same basis. And then when somebody moved out, in Mum's case, was forced to move out, then they were able to get the open market value. So there's always been this kind of where we are now, where the landlord holds all the keys. They'll charge you what they want. Tenants got little or no protection. Back to how it was, 60 years ago, where the tenant had all the things in their favour and the landlord didn't. There is a medium ground. There is a middle ground, sorry. But in all my years I've been involved in housing, there's no joined up writing between, social housing, private rented, social rented. Nobody's ever come together and sought opinions of how things could be done a lot easier, and there could be some sort of integration between all four areas. So I like you, wait with an element of cynicism about whether this is actually going to get off the ground, or whether it was just another piece of sticking plaster attached to something that is got cuts all around it, in the sense of it was something else to kind of feed to the press. And it's difficult not to think of it as a slightly cynical political move, but as I said right at the beginning, try and keep in politics out of it. Somebody might benefit. We'll have to wait and see. But there's not enough meat on the bones at the moment to realistically be able to comment. Let's see what happens, and then perhaps we can, when there is a bit more information, perhaps we can do a catch up and analyse it then, because it may be of interest to your subscribers.
That brings us to the end of our chat. Well, I'll let anyone know that wants to get in touch with Ken, is that his details can be found down in the description of this video. But yeah, just before we go, I just want to say thank you again for
agreeing to
do the chat with me.
I enjoy it, and yeah, I think it's lovely, because it's an opportunity for me to think about it from a slightly different angle, but at the same time, just to share a few tips for anybody really, that don't be afraid to make that first move. Don't be afraid to ask, because my final point is, I do this all day, every day. Most people are going to do it once, twice, maybe 3 times in their life. So, no question is ever too daft. We'll have a little chuckle about it afterwards. But in a nice way, we're happy to answer questions all day long, because it's so important that you get the answers to your questions, and then you feel comfortable about what you're taking on. Because I can give you, a lot of people say to me, what would you do? And I always bounce it back and say, well, I can tell you what I would do, but ultimately I haven't got to pay your mortgage at the end of the day. So it's kind of important that you make that decision. I'll tell you what I would do, but then you've got to be comfortable with what you're committed on in terms of the monthly payment. And it works, because you can have backwards and forwards questions. I mean, we answer lots of questions on email, we answer a lot of questions face to face, and until it's important that you know exactly what you're letting yourself in for. So opportunities like this don't come along very often. I'm always delighted to make a contribution, because I believe passionately that you ought to seek that advice from somebody. It doesn't have to be me. There are lots of excellent mortgage advisors out there who will give you the benefit of their experience and advice, because it's not something you'll get taught at school, sadly. So you have to kind of make your own way into the big bad world, and do your research and find out who you're happy to deal with.
Mm-hmm. And hopefully, just from our chat, people can see the value in talking to a mortgage advisor.
But we don't buy it. That's not what you mean. No, and we do. We have a bit of fun en route. And if anybody's watching and you are a football fan, then as Lemuel will know, I'm a massive Crystal Palace fan, so I'm happy to speak. Well, I think I can just about talk football at the moment, given the season that we've had. But I won't mention the England result, which was they were 3-0 down when I left about 2 or 3 minutes before we did this.
Watching it was 1-0. I saw
they were 3-0 down.
the first one.
So I think tomorrow's headlines will be about Gareth Southgate and probably not about the bank base rate. That's just major case.
I agree with you. They'll be calling for his head. But yeah, no. Until next time, Ken.
Cheers, buddy. In regards to your family, and I hope they're all well. And look forward to catching up with you again soon.
Thank you. And
just if you haven't already, please give the video a like if you've enjoyed the video, and I'll see you in the next one. Take care.